Hello and welcome to this training video on overcoming common trading biases. In this video, we will explore some of the most common biases that traders face and discuss strategies to overcome them. Trading is an emotional and psychological game, and understanding and managing biases is critical to successful trading. Without further ado, let's get to it. 1. Confirmation bias. Confirmation bias is the tendency to seek out information that supports our existing beliefs and ignore information that contradicts them. In trading, confirmation bias can lead to a trader holding onto a losing position for too long or ignoring signs that the market is moving against them. To overcome confirmation bias, traders should seek out and consider alternative viewpoints and actively look for evidence that contradicts their beliefs. They should also set stop-loss orders to limit their losses if the trade goes against them. 2. Overconfidence bias. Overconfidence bias is the tendency to overestimate one's abilities and the accuracy of one's predictions. In trading, this bias can lead to a trader taking on too much risk or failing to properly manage risk. To overcome overconfidence bias, traders should keep track of their trading performance and be honest with themselves about their successes and failures. They should also use risk management techniques such as diversification, position sizing, and stop-loss orders to limit their losses. 3. Anchoring bias. Anchoring bias is the tendency to rely too heavily on the first piece of information encountered when making a decision. In trading, this bias can lead to a trader holding onto a position for too long based on a past price level or target. To overcome anchoring bias, traders should avoid becoming fixated on a single piece of information and should instead consider a range of factors when making decisions. They should also set realistic price targets and adjust them based on market conditions. 4. Availability bias. Availability bias is the tendency to rely on readily available information when making decisions rather than seeking out additional information. In trading, this bias can lead to a trader making decisions based on recent news or events rather than considering broader market conditions. To overcome availability bias, traders should seek out a variety of information sources and consider a range of factors when making decisions. They should also avoid making impulsive decisions based on recent news or events. 5. Loss aversion bias. Loss aversion bias is the tendency to prefer avoiding losses to achieving gains of the same magnitude. In trading, this bias can lead to a trader holding onto a losing position for too long in the hope that the market will turn in their favor. To overcome loss aversion bias, traders should set realistic stop-loss orders and stick to them. They should also focus on the long-term performance of their trading strategy rather than individual trades. 6. Hindsight bias. Hindsight is a cognitive bias that refers to the tendency of people to believe that they would have predicted an event's outcome after it has occurred. In the context of trading, hindsight bias can manifest as traders believing that they could have predicted a market event, such as a stock market crash or an economic recession, after it has happened. Traders who fall victim to hindsight bias may overestimate their ability to predict future market movements and make decisions based on past events that may not be relevant to the current market conditions. This can lead to overconfidence in their trading strategies and potentially risky investments. Hindsight bias can also lead traders to second-guess their decisions and become overly critical of their past choices. For example, a trader who sells a stock that later increases in value may feel regret and believe that they should have held onto the stock, even though their decision was based on the information available to them at the time. To avoid the negative effects of hindsight bias in trading, it's important for traders to acknowledge that past events do not necessarily predict future outcomes and to remain vigilant in their analysis of current market conditions. They should also keep detailed records of their trades and decisions, which can help them evaluate their strategies objectively and avoid falling into the trap of hindsight bias. 7. Sunk cost fallacy. The sunk cost fallacy is a cognitive bias that refers to the tendency of people to continue investing in a project or decision based on the resources they have already put into it, even if it no longer makes sense to do so. In the context of trading, the sunk cost fallacy can manifest as traders holding onto a losing investment because they have already invested a significant amount of time, money, or effort into it. Traders who fall victim to the sunk cost fallacy may continue to hold onto a losing investment in the hope that it will eventually turn around, even if the market conditions suggest that it is unlikely to do so. This can lead to significant losses and prevent traders from cutting their losses and moving on to more profitable investments. To avoid the sunk cost fallacy in trading, it's important for traders to evaluate their investments objectively and make decisions based on current market conditions rather than on past investments. Traders should have a clear exit strategy in place before entering a trade and should be willing to cut their losses if the market moves against them. They should also be aware of the emotional attachment that can develop when they invest a significant amount of resources into a project and strive to make decisions based on rational analysis rather than emotional attachment. 8. Regression to the mean bias. Regression to the mean bias is a cognitive bias that refers to the tendency of people to assume that extreme events or outcomes will tend to move back toward the average or mean over time. In the context of trading, regression to the mean bias can manifest as traders assuming that an investment that has performed extremely well or poorly in the short term is likely to revert to its average performance over the long term. For example, a trader who sees a stock that has performed exceptionally well over the past few weeks may assume that the stock is likely to continue performing well in the future. Similarly, a trader who sees a stock that has performed poorly over the past few weeks may assume that the stock is likely to continue performing poorly in the future. This assumption is based on the belief that the stock's performance will eventually regress to its long-term average. The problem with regression to the mean bias is that it can lead traders to make faulty investment decisions based on flawed assumptions about future performance. Traders who fall victim to this bias may be tempted to buy or sell investments based on recent performance rather than on objective analysis of current market conditions. To avoid the negative effects of regression to the mean bias in trading, it's important for traders to focus on objective analysis of current market conditions rather than on short-term performance trends. Traders should use technical and fundamental analysis to identify trends and potential opportunities in the market and should avoid making decisions based on emotional attachments or biases. In addition, traders should be aware of the risks associated with chasing short-term performance trends and should focus on making disciplined, long-term investment decisions that are based on objective analysis and research. Overcoming trading biases is critical to successful trading. By understanding and managing biases such as confirmation bias, overconfidence bias, anchoring bias, availability bias, hindsight bias, sunk cost fallacy, regression to the mean bias, and loss aversion bias, traders can improve their decision-making and trading performance. By using strategies such as seeking out alternative viewpoints, using risk management techniques, avoiding becoming fixated on a single piece of information, seeking out a variety of information sources, setting realistic stop-loss orders, and focusing on long-term performance, traders can become more effective and successful traders. If you wanted to read about common biases, I would recommend Thinking Fast and Slow by Daniel Kahneman. It gives you a good understanding of biases. Understanding biases will help you make better decisions not only in trading but in life.